You're at the bank. It's a Thursday afternoon. You're signing papers for a mortgage. $385,000 for a 3-bedroom house in a decent neighborhood. Not your dream house, but a good house. The kind your parents would be proud of. The kind that means you made it. The loan officer slides the final document across the desk. 30-year fixed-rate mortgage at 7%. Your monthly payment will be $2,560. Principal and interest. Add property taxes and insurance, and you're at about $3,100 total. You sign. You shake hands. You drive home. And that night, you pull up the amortization schedule online, just out of curiosity, just to see how it breaks down. And there's this number at the bottom that makes you stop. Total amount paid over 30 years. $921,600 for a house that costs $385,000. You read it again. $921,600. You're paying $536,600 in interest. You're paying more in interest than the house actually costs. And suddenly this achievement, this milestone that's supposed to represent stability and success, feels different. You just signed up to pay the bank $536,600 over 3 decades for the privilege of buying a house that costs $385,000. My name's Peter, and if you've ever felt like the traditional path to wealth, the house, the car, the steady job, requires so much debt that it can't possibly work mathematically, make sure you hit that subscribe button, because the American dream as it's sold isn't just hard to achieve. The math is fundamentally broken.
So let's start with what a typical middle-class financial life actually looks like when you add up all the debt. You graduated college in 2018. You've got $42,000 in student loans. Standard repayment plan, 10 years, 5.5% interest. Your payment is $456 a month. Over 10 years, you'll pay $54,720 total. That's $12,720 in interest. You need a car for work. You buy a reliable used car. $28,000, financed for 6 years at 6.5%. Payment is $490 a month. Over 6 years, you'll pay $35,280 total. That's $7,280 in interest. Now the house. $385,000, 30-year mortgage at 7%. We already know the numbers. $2,560 a month, $921,600 total, $536,600 in interest. Add it up. Over the course of your adult life, assuming you follow the standard path, college, car, house, you'll pay roughly $556,600 just in interest. That's over $500,000 that you're paying to banks for the privilege of accessing things you need to participate in middle-class life. You're not buying luxury goods. You're buying education, transportation, and housing, the basics. And the cost of accessing those basics via debt is $556,600 in interest payments over your lifetime.
And here's what that actually means monthly. In your 20s and early 30s, you're paying $456 for student loans and $490 for the car. That's $946. Then you add the house. Now you're at $3,506 just for debt service. Before food, before utilities, before anything else. You're making $68,000 a year. After taxes, about $4,250 a month. Your debt payments are $3,506. That's 82% of your take-home income going to debt service. You've got $744 left for everything else. This is the American dream as it currently exists. You're not building wealth. You're servicing debt, while banks build wealth from your interest payments. Most people think the problem is that houses are expensive and student loans are predatory. And those things are true, but that's not the core issue. The core issue is that the system is designed to make debt feel necessary and normal, while the math of debt makes wealth accumulation nearly impossible for most people.
Here's what I mean. In 1970, the median house price was $17,000. Median household income was $9,870. A house cost 1.7 times annual income. If you saved aggressively, you could feasibly pay cash or have a massive down payment. By 2000, median house price was $165,000. Median income was $41,990. A house cost 3.9 times annual income, getting harder but still sort of manageable with a decent down payment. Today, median house price is $420,000. Median income is $75,000. A house costs 5.6 times annual income. Paying cash is impossible for most people. Even a 20% down payment, $84,000, takes years to save while you're paying rent. So you're forced into debt, not because you're financially irresponsible, but because the math of wages versus asset prices doesn't leave another viable option.
And here's where the trap closes. That 30-year mortgage, it's not really a path to ownership. It's a 30-year extraction mechanism. Let's look at how your mortgage payment breaks down in the early years. Your payment is $2,560. In year one, about $2,240 goes to interest, and only $320 goes to principal. You're paying the bank 7 times more than you're paying down the actual loan. After 5 years of payments, $153,600 total paid. You've only reduced your principal by about $18,000. You've paid $135,600 in interest. You still owe $367,000. You're barely making progress. After 10 years, $307,200 paid. You've reduced principal by about $42,000. You've paid $265,200 in interest. You still owe $343,000. It takes about 20 years, over halfway through the mortgage, before your monthly payment is going more toward principal than interest. 20 years before the math tilts in your favor. This is the debt trap. You're paying massive amounts every month, but the structure is designed so that the bank extracts maximum interest in the early years when you can least afford it.
And here's the psychological mechanism that makes this particularly insidious. It's called debt normalization. We've been conditioned to see debt not as a temporary necessity, but as a permanent feature of financial life. You grow up watching your parents have a mortgage, car payments, credit cards. It's just how life works. You go to college, and everyone takes loans. It's normal. You buy a car, and financing is presented as the smart choice. Keep your cash, low monthly payment. You buy a house, and a 30-year mortgage is standard. At no point does anyone ask, is it actually financially optimal to be in debt for 30 continuous years? Or is this just the system we've inherited and accepted without examining the math? Because here's what debt actually costs you, beyond the interest payments. It costs you flexibility. It costs you opportunity. It costs you the ability to build wealth. Every dollar you pay in interest is a dollar that could have been invested. And over 30 years, the compound cost is staggering. That $2,560 mortgage payment, if instead of buying the house, you rented for $1,800 and invested the $760 difference at 7% returns, here's what happens. After 10 years, $132,000. After 20 years, $395,000. After 30 years, $912,000. Meanwhile, if you bought the house, after 30 years, you own a house worth maybe $600,000, assuming 2% annual appreciation, and you paid $921,600 to own it. Net position, you're down $321,600. Plus, you had zero liquidity for 30 years, and all your wealth was tied up in one illiquid asset. The renter who invested the difference, they have $912,000 in liquid investments, and they could use a portion of that to buy a house cash if they wanted to. Same income, same discipline, completely different outcomes, because one avoided debt and the other accepted it as normal.
Now, I'm not saying renting is always better than buying. There are legitimate reasons to own: stability, control, specific markets where buying makes sense. But the point is, we've stopped doing the math. We've accepted that you're supposed to take on massive debt, And we've stopped questioning whether that's actually the wealth-building strategy it's presented as. You're lying awake. It's 2 a.m. on a random Wednesday. You're thinking about the house again, about that $921,600 total payment, about the fact that you're 29 and you just committed to 30 years of $2,560 monthly payments. And you're doing the math. What if you lose your job? You've got maybe $8,000 in savings. That covers 2 months of mortgage payments. Then what? You're supposed to have 6 months of expenses saved, but with student loans and car payments and everything else, you never got there. And that tightness in your chest, it's not buyer's remorse exactly. It's the realization that you just made the biggest financial commitment of your life, and the math is terrifying. You're locked in for 3 decades. 1 job loss, 1 medical emergency, 1 unexpected crisis, and the whole thing collapses. The American dream is supposed to provide security, but the debt required to access it creates profound insecurity.
So here's how people who actually build wealth think about the American dream differently. They don't reject home ownership or education or transportation, but they reject the idea that massive multi-decade debt is the only path to those things. When they look at a $385,000 house with a 30-year mortgage, they don't think, can I afford the monthly payment? They think, what is this actually costing me in total, and is there a better way? Maybe they buy a $280,000 house instead of $385,000. Smaller, less impressive, but manageable. Maybe they rent for 5 more years while aggressively saving for a massive down payment, so the loan is smaller and shorter. Maybe they buy the house but plan to pay it off in 15 years instead of 30, which cuts the total interest paid nearly in half. The point is, they're optimizing for total cost and financial freedom, not for what they can technically afford monthly or what looks impressive. And here's what changes when you think this way. You stop seeing debt as inevitable. You start seeing it as expensive and optional, and you make different decisions. You keep the paid-off car for 2 extra years instead of upgrading. That's $11,760 in payments you avoid, plus $7,280 in interest you never pay. You invest that money. Over 20 years at 7%, that $19,040 becomes $74,000. You pay an extra $500 a month on your mortgage in the early years when it's all going to interest anyway. You shave 11 years off the loan and save $186,000 in interest. You're living in the same house, driving the same car, but you're extracting yourself from debt years ahead of schedule, saving hundreds of thousands in interest, and building actual liquid wealth instead of just servicing obligations. Now let me be very clear about something. The math I'm showing you isn't accessible to everyone. If you're barely making rent, you can't save an extra $500 a month. If you're working 2 jobs to survive, you can't optimize debt payoff. This isn't about individual responsibility. It's about a system that makes debt necessary for basic middle-class participation and then profits massively from that necessity. But for people who do have some margin, who have $500 or $800 discretionary monthly, the choice is real. Spend that margin on lifestyle upgrades or use it to extract yourself from debt trap faster. Most people choose lifestyle. They see the extra money as permission to improve their life now, and they end up in debt for 3 decades. The ones who choose freedom see the extra money as leverage to exit debt faster, and they end up financially independent years earlier. Same starting point, different framework, completely different destination. So here's the thing about the American dream. The version we inherited, college debt, car debt, mortgage debt, all stacked continuously for 30+ years, is mathematically broken. You'll pay over $500,000 in interest following that path. You'll spend 3 decades servicing obligations, and at the end, if everything goes perfectly, you'll own a house and have some retirement savings. But that's not wealth. That's survival with a nice asset at the end. Real wealth is liquid, it's flexible, it's having options. And you can't build that when 82% of your income goes to debt service for 30 years. The American dream as it exists today isn't designed to make you wealthy. It's designed to make you a profitable customer for financial institutions. And the sooner you see that clearly, the sooner you can build something different.